Good morning and welcome to another episode of CREDE Play Offense. Today I'm truly honored to have one of my dear friends, Sean Armstrong, Westport Capital Partners, join us. Sean and I have known each other for over 20 years, going back to Oak Tree days, and now Sean is a founding member and managing principal of Westport. Good morning, Sean. How are you?
Good, Colby. How you doing? Good to see you.
You too. You too. So we're not just going to cover kind of your traditional blocking and tackling, like what are capital markets doing today. This is as much about, how did you and I get into this business? Why do we love doing what we're doing? Et cetera. So maybe give us, and the listeners a little background on not just Westport, but you as well. I mean, you didn't come up just as a true, kind of analyst and coming through. You came in as a CFP. You had different avenues and careers in your life, and before you got where you are today. So, if you don't mind, give us a little overview of your background and Westport in general.
Sure. Well, I'll start my brief history is my original undergraduate degree was in biomedical engineering. I thought I was going to go to medical school, which I did for a time, but realized that wasn't where my heart was. I wanted to be in the business world somehow. I just didn't know how. And so had an early exposure to commercial real estate as a broker and a few other activities. Realizing I needed to formalize my education, went back to school, get my MBA at USC. And when I graduated, I started work at Trust Company of the West, initially in their high yield group, which was part of their distressed overall activities. And that quickly morphed into a distressed real estate effort in the early 90s as we were coming out of the RTC and the savings and loan challenges. So shortly after that fund was formed in 94, we left our group, a whole floor of TCW moved out to start Oak Tree in 95, and our real estate group went with them. So we really blossomed while we were there. This was the 90s. It was into the 2000s. We were working domestically, a lot of distressed real estate acquisitions, a lot of loan acquisitions, really a very far-reaching expanse of the type of real estate investing that we were doing. And that actually morphed into international. I was one of the guys that opened initially the Tokyo office for Oak Tree, and then subsequently the Frankfurt office for Oak Tree. So we did international transactions, both buying distressed assets in Europe and in Japan. And then in the mid 2000s, the group, leader of the group at the time decided he wanted to branch out on his own. So a few of us went with him, and we started Westport. And it's been, I describe it as having basically had the same job for 30 years, just wearing 3 different jerseys. And now Westport really has been the majority of my career, my time for the last, I think we're coming up on 18 years here in 2024. So today, Westport is a over $5 billion asset manager, primarily focused on some sector-specific strategies and some more diversified funds. And we have a combination of portfolios that are organized either towards, on the diversified side, today we're very much a value add manager with a little spice of development thrown in. And I think today we would probably describe us as a distressed investor, just not in the traditional sense of buying distressed properties. I can talk about that more, what that nuance is. And then our sector-specific strategies, which involve the largest of which is an automated frozen warehouse business that's headquartered in Europe, but we have a footprint in, I've lost track now, probably 8 or 9 countries in Europe, the United States and Australia. We have another strategy dedicated to single-family homes for rent. It's a smallish portfolio, but a nascent one. And then the third sector specialization platform we have is dedicated to developing master plan communities, today only in Florida, where all we do is the horizontal development. We go in and map out what are 2,000 acre parcels, and then create the community, put in all the horizontal infrastructure, and then sell off super pads and what have you to the home builders who do all the vertical. So we all of those efforts grew out of original diversified funds, and we continue to look for those opportunities. We have a few of those things percolating now, which could be future sector-specific verticals for us.
Very cool. So, maybe spend a minute and touch on, as you said, that what's the difference between, being a distressed investor and distressed real estate? Like, how are you nuancing that now? And, and you have, having known you for the years I have, you've played in everything from notes to bonds to buying banks to buying distress to, rescue capital, etc. So I am intrigued on how you're kind of slicing and dicing distress today, and then, and what you see for the future as well.
So yes, you very accurately described the whole continuum of different type of investment vehicles or ways that we made investments. We did a lot of note purchasing in the 90s and some in the 2000s, both at Oaktree and at Westport. One of the fun parts about being associated with Oaktree at the time, frankly, was the fact that we sat right next to the distressed corporate desk. And at the time, a lot less so now, but there were a lot of ways to participate in distressed real estate. We bought bonds. Sometimes, there were assets in New York, for example, that were single asset bond issuances that were almost $1 billion in face value, or there were securitized bonds that might have been secured by a portfolio of Kmart's, for example, or Toys R Us. And a lot of those kind of interesting instruments have sort of gone away. Even at one point, we had a second lien zero coupon on the U.S. Patent Office in DC. That was a very interesting trade. So a lot of those more exotic instruments have kind of gone away, and they were very interesting. They were very profitable investments, and they were fun to work on because they were kind of complex. Today, most of the financing has, I think, concentrated, especially post GFC, into traditional, CMBS. There's a new emergence people call SASB bonds, which are single asset, single borrower. It might be a single asset, or it might be a portfolio of assets by a single borrower. And those have become very efficient ways to finance assets. And when they get into trouble, they can be interesting. But our focus has really morphed for the last 5 years into really single asset type of investing, and really focused on value add. And that's really the culmination of 25, really at this point, over 30 years of investing experience. That some of those sexier looking kind of instruments can also take longer. Notes can take longer to get access to the equity. It can cost you more. And so while your going in basis might be very attractive on a per square foot or per unit basis, your returns can get diluted by time. And so when I stepped into the role 5 years ago, I wanted our strategy to really get a lot more disciplined, a lot more refined. And we did that sort of in 3 ways: by asset type. So principally direct real estate investing, sector specific, probably 4 ways really: sector specific, a very tight focus by sector, and really focusing on the sectors that we thought had the most dynamic and enduring demand trends behind them that would really, I won't say transcend business cycles, because they certainly are being affected by them now, but at least that a very solid tailwind. And that's been principally for rent housing and industrial, kind of broadly defined, and then supplanted with a sprinkling of student housing, self-storage, a little bit of hospitality, and those all have some characteristics. I can talk about why we picked those sectors. A geographic focus, so that's the third pillar of our strategy today, which is really tight focus on what we deem to be the top 30 MSAs in the country that have, again, great tailwinds behind them, demographic factors, job growth, income growth. Not everything will go your way in a particular asset, but if you've got a good tailwind behind you, it'll help smooth those bumps out. And then really, I could probably think of a couple other dimensions, but size kind of matters, overall asset size. we tend to focus on assets between 25 to 75 million. I know that's a broad range, but we find that to be a very liquid part of the market. When we go out to sell, I always want us to have as deep a buyer bid as we can. And then what I would say is the fifth dimension today, and why I made the distinction about what a distressed investment looks like today that's attractive to us, is really a distressed seller. And that's a key distinction from our past. Whereas, we would be buying distressed assets, properties that needed a heavy lift for a turnaround, heavy remodels, repositioning, maybe even a conversion, or again, a distressed situation where you have a bankruptcy or foreclosure pending. Really to just focusing on buying the highest quality assets that we can from sellers who are in need of selling. And that's really the environment we find ourselves in today. We have been for the last 2.5 years, frankly, since the peak of the market at the beginning of end of 21, beginning of 22. So that distress, that is the key nuance for us today that we find very attractive.
Well, and I would say, knowing you and your team, and different than some other private equity funds. So as a fund manager, you're managing a discretionary funds, and some just, are fund of funds and will put money into funds. Others are just purely LPs where they look for operators. You guys are both. So, for our listeners, there's brokers that can bring you guys direct deals where you can execute it on, yourselves without a partner per se. But I'd say the majority of your work is with good vetted partners. And so kind of listening from what I'm hearing, you're talking a lot about, a distressed seller, sector specific, some industrial, some cold storage, some master plan, single family for rent. You maybe get into a little bit more of the geographical sectors that you're looking for deals or looking for good partner sponsors to work with.
So to roll back to what you said initially, we do have a number of assets where we have direct investment. I will say that those tend to be legacy office assets today. And in the for rent space and in the industrial space, those are very broad categories, and you can peel down pretty quickly to the relative sort of subsectors. So, for instance, we do have a fair number of, I would call over the plate, garden style multifamily assets, but we also have build to rent developments. We're working on a manufactured housing community portfolio today, and so we have in recent years probably relied more on finding good operating partners. We're always very in touch with the assets. We're on leasing calls. We are engaged with hiring brokers. We keep them, hold them accountable along with our operating partners, but we try to find market specific experts, whether it's a product expert or market expert or both, where they can bring something to the table, and then we bring 30 years of investment experience, our track record, our scars and bruises, and then other levels of sophistication as well on the financing side, access to the public markets, private markets, and so we look for opportunities to create true partnerships with our operating partners. So we're not just a passive LP, but that we are alongside them in creating value. And so I would say we're always open. I tell people I'm always interested in making new friends. We like meeting new people and being exposed to new opportunities and new ideas. On the market specific stuff, it won't surprise you. We have a map on our website that pretty accurately pinpoints the markets we care about. And so, as I said, there's a commonality for all these markets. And we've gone through a process now twice of doing a really deep dive from a research and analysis point of view to look at the markets we think will perform the best. And that's taking into a combination of things, for instance, like the ULI emerging trends in real estate. They do an excellent job of compiling what's ultimately investor sentiment, which is interesting. They compile investor sentiment, and why is that important? Well, because if you're going to invest and again, as I said, we want to be investing in assets that we think we're going to have good liquidity on the outside. Understanding what people are looking for when we take a diamond in the rough and polish it and then put it back on the market, knowing which markets investors are devoting capital to is super important. So that's one of the things that we look at, and then we look at first, sort of second and third tier kind of data, the obvious stuff, population, domestic in-migration. We look at obviously GDP growth, job growth. We look at so those are first tier kind of factors. Second tier factors would be things like the tax and the political and the business environment. Are they jurisdictions where investment is being encouraged and rewarded and prompted, as opposed to capital unfriendly locations? And we certainly have a lot of capital unfriendly locations in the U.S. that coincidentally happen to be a lot of the gateway cities today. And then the third tier, not that they're less important, but they're very important, but more subtle. Things like availability of power, availability of other resources, exposure to climate issues, and now the big thing on everybody's mind, or should be on everybody's mind, is insurance. The insurance costs have escalated dramatically around the country, but in pockets, not necessarily uniformly. So, for us, those markets are Mid-Atlantic South. They're other parts of the Southeast, Tennessee, obviously Texas, the Southwest, Phoenix. We used to include the Pacific Northwest in that, and we have turned pretty negative on the Pacific Northwest markets. Again, they've become extremely business unfriendly environments, gotten worse, and so not from our perspective, capital doesn't get treated well. The markets we do think capital gets treated well in the West would include Salt Lake and parts of Denver, I would say. These are growing in areas. I say it always comes down to demographics. It's very simple. Go where the people are going, because how they use and how much they use real estate is rewarded.
Well, and I'll give you guys and your team some free props and promotions there. You and I have worked with each other in excess of 20 years, and CREDE had an exclusive relationship with Westport for about 7, and it's not just for your partners, but truly your team. It's not. I always look and go, when things are good, everybody's floating on. It's the old, when the tide rises, boats float together. But it's really looking at your in-house asset management team, your acquisition folks, your structural folks. That when you say you're on a leasing call, that's not a joke. I mean, it really is side by side with your partners. It was side by side and has been with me for years and our team. And you're solving problems. It's not, it's not a game of whack-a-mole. It's a game of how do we all make money together. And when I was truly the service provider to you, it was one of the things you always taught me was, look, your job is not to, try to drive things out of the GP or eke the last penny. It's make a profit, but get that operator to come back to do another deal with Westport, because you want the partnership and such. And it's always been, to me, a testament of the fun of working with you is like two things. It's that and the ability for you to go from 10,000 feet to 2 feet and back up, and us to really look at every nuance of a deal together at high speed, which not a lot of people can do. So I give your team a lot of testament and credit for that.
Well, thank you. It does start with, in our hearts, we're real estate guys and girls and ladies. And so, there's a lot of passion for the investment sector. We do pay attention to other parts of the capital markets. We have to, because it's inextricably linked. The debt markets are inextricably linked with real estate, and I can talk a little bit about that. But that feeling. I mean, you and I have been through it personally a number of times, whether it was Turtle Bay or Hotel La Jolla, or I'm sure I could come up with 7 other examples where, we started out with something that was in pretty rough shape, and through the application of capital and a lot of hard work and time and effort, we were able to create something that, we were very proud of. Hopefully we made money along the way, and we both know that wasn't always the case, or we didn't make necessarily as much as we wanted to. In some cases, expectations were greatly exceeded. But there's a permanence to real estate. And it's funny, I tell my kids, we'll be driving around someplace and sort of randomly, I did that deal over there, whether when I was a real estate broker 40 years ago, or when we were at Westport or Oaktree or TCW, we did that. I was out in St. Louis with my wife for her business about 3 weeks ago, and driving down, Highway 40, and yep, there's the Mercy Healthcare headquarters building. I made $20 million with 3 pieces of paper, a 3-page lease amendment there. And that's a fun thing to be able to do. Some of the bigger projects, you lived out at Turtle Bay. We still remain involved. Our family is embedded there. Every time I go there, it's amazing to be able to think of how much influence we've had on the land. And in some cases, not having an impact on the land. At Playa Vista, we did, and I was part of a board, so it was a big team, but we entered into a very unique construct, basically a non-development easement, a conservation easement on, I want to say it was 200 or 300 acres of property, where we agreed in exchange for getting the right to do some things in one place. We made agreements to permanently dedicate open space and improve some of that open space with the conservation easement. And that was a very novel, unique thing that has since been proliferated. And in fact, when I was on the board at Turtle Bay, we took a page out of that playbook and did the same thing to preserve a very, very unique slice of heaven called Cavella Bay. We took, I think, about 40 acres there and dedicated to conservation and preserved open space and public access to coastal assets and jewels. And so sometimes it's the impact you don't have that can leave a lasting memory, a lasting effect. So kind of wandered off on a tangent there, but it's why we like real estate. There's a permanence to it that hopefully you can be involved in a project and be very proud of your efforts afterwards.
And I do want to get back to debt markets in a minute, but you bring up real estate. To me, it's permanent. There's a great deal of it. We try to explain to everyone in CREDE, it's we think like owners because we're developers, we're service providers, we're owner reps, we're sponsors. Mostly we're third party owners reps and project managers. But it's you always hear people say, "Oh, that's my project," and here you say I'm on the board. It's always say like, look, if I'm a sponsor, I have an LP, I have an investor. I also have probably a lender. I've got different boards. Like we're always answering to someone, but you have to always think of it like it's your own. Yeah. Whether you're starting as an assistant project manager or an analyst, and that grit and that ownership and that how do you drive it forward? Because people forget that time costs money, and every single day you just need to wake up to me and drive some kind of solution to move the ball forward and to unlock, your boss's ability to do what they're supposed to do. Is there, what is it that Westport's looking for in new hires, or are there certain, like for newer listeners, people coming into this business, are there, I came out of the track of being a contractor and then being kind of on the analyst side and then being a developer and doing the direction I went, from the field, which is a kind of a unicorn. You went from the broker side and then, more of as you said, to the masters, to MRED, to private equity. Is there, what's the path or any advice that you're giving your kids of how to come up if they want to be in this business?
I have an MBA in finance. I actually didn't go to the MRED program. In fact, the funny thing is that when I went to business school, I thought I was going into the glamorous world of money management and securities. I thought I left real estate behind, and it's like Al Pacino said in Godfather, "They keep dragging me back in."
Keep thinking we're going the wrong direction.
Well, it was very funny. So it only took me about like a year when I was a high yield credit analyst to get back involved in real estate in 1993, I think it was, and I've not looked back. I love doing it. I'll say two things in terms of what you just said. One is, how do we instill, that mindset, and really is having that ownership mentality. We have, as a fund manager, we have a general partnership investment, our capital, firm capital, partner capital in all of our funds. So our money is in there next to our investors, but they've got 90+% of the capital. But I never think about it that way. I always think about it as though these are our assets. And so you have to have that ownership mentality, and it requires focus, to try to keep up with all the deals, and to make sure that, like I still today, I participate in a lot of those leasing calls for a lot of our assets, especially our more difficult ones. We do have some legacy office assets, so trying to figure out what we do with those assets. What do we do anything with them? We're putting good money after bad, having to be in the trenches and make hard decisions, and you feel it. You lose sleep. You wake up in the middle of the night thinking about it. It affects you. You personalize it, and I think it's creating the culture, and our folks see it. Whether it's me or Greg or Jordan, or Peter or Howard, the investment folks, we sweat that stuff, and so they get engaged. I think it energizes them. It's infectious, and it's not necessarily. There are times when you're having a conversation, or you're having to think. I just frankly was having a conversation with one of my colleagues in the West Coast office this week. I live on the East Coast, but spend time on both coasts. And, I came up, it's kind of funny. I came up with an idea for one of our assets, and the response was, I hadn't thought about that. And it made me feel good that I was, even at my advanced age, I can still come up with fresh ideas about how to solve a problem, because we've got to, there's a problem that needs to be solved. Adopting an owner mentality. I used to have I'm the first American in my family. I used to have a little sticker, when I first started working, that I had on the bottom of my computer screen: think like an immigrant. And that mentality of, nothing's going to fall in your lap. You have to create everything that you have. Yes, you don't do it on your own. You are relying on the infrastructure that is created around you immediately, what your parents did for you, what the people that came before you did, what America is as an idea, and how much relative freedom, may not always feel that way, but how much relative freedom we have in this country versus others. And having invested in other countries and spent a lot of time in other countries, there is a great deal of freedom, much more freedom here than some of those other places. But what I've got five children. I've got another son by marriage, and two of them are in the real estate business, and they love it. And they're young, and they're enthusiastic, and it's fun to watch. And one of them works for himself and his father in a family real estate portfolio, and he lives and breathes it. And then I've got another son, my own son, who's at a very large real estate firm, global real estate firm. And he's been there for about 3 years and is rapidly ascending as one of their star analysts and asset managers. And it's, I'll tell you, it's fun to be able to talk shop with my son, to be able to discuss markets. What are you seeing? What are you guys doing? Here's what we're doing. Discuss, sometimes we're kind of competing in the same market, oddly. And that's been a great reward. So I tell my kids, work hard, be invested, don't be lazy. I've got a whole lot of dad-isms I can share.
Yeah, mine. I always say, first rule is show up.
Right.
You can
exactly
walk through the door. But when you guys are when you and Greg and Jordan are recruiting for Westport, it's interesting because your backgrounds are all different. You were a broker Greg was a tenant rep. Jordan came out of a trading desk. What were you looking to recruit from today? Is it brokerage shops, MBA shops, or analysts, or like kind of what's the typical background now for a new incoming Westport employee?
So we have mostly hired people that are coming to us either out of secondary, so advanced degree programs, or with meaningful work experience. To be honest with you, we've only hired a relatively small number, like maybe 2 folks that came to us right out of an undergraduate program, and there was something unique about those individuals that made them good candidates. For the most part, we're looking with folks who have a lot of financial and real estate literacy already. They generally are coming to us from smaller organizations, not larger ones. What's interesting is that the folks, and it's a funny thing to say, but for me, it's a point of pride that for the most part, the people that have left us have gone to much bigger name brand organizations. And so, I'm always glad that somebody can take what they've learned at Westport and go someplace else, and they can, add some value. That employer sees value in what they're doing. It may be that they've sort of reached a logical point with us, and that's when they, whatever reason, they decide to go someplace else. But the fact that, if I look at the names of the shops that they've gone to, it's a who's who of global investment firms. But like we have folks that have, as I said, advanced degrees. We've got folks that have architectural degrees, and engineering. We actually have a fair number of people that had some kind of engineering or science background, which I think lends itself well for a variety of reasons to real estate investment. Obviously, people that come with finance backgrounds, but we're very selective, and we try to remain relatively lean in our footprint relative to the assets that we manage. One of the things that we've been trying to do more of is create scale. And I think I actually got this phrase from you. It's not yours originally, but I think it got you. Force multiply, and the ability to leverage resources and leverage the outside partners and what have you, whether they're the operating partners or our legal firms or folks like CREDE for sure. We've leveraged you guys a ton for all the work that we've done, all the renovation that we've done. You guys have been, an extremely valued partner, whether it was you personally when we were at Oaktree at TBR, or when we all started. I think you started CREDE right around the time that we started Westport, and the organization that you've built up that has been extremely necessary, supportive in good times and in bad. We've had plenty of situations that we've had to work our way out of situations and problems, and then a lot of successes along the way as well. So, we try to keep our team lithe and agile, and bring in those resources like you guys, when necessary, to be able to get done what we need to get done.
Well, and
a little commercial was unintended.
And it's not just groups like ours, but I mean, I go back over our history, and whether it was Oaktree or Westport, I've been part of it, watched it, where you've launched, you guys have launched self-storage platforms, healthcare platforms, cold storage, seeing operators. You go back to CenterCal, you were one of their original partners back at Oaktree days, and seeing some great companies that you've taken programmatic approaches with, that have gone on not just to continue partner with you for years, but created legacy assets. So again, for it's not to, selfishly plug you, but I've seen you do it time and time again. And, with partners that have come back on a repeat basis and done programmatic things with you. So that's a testament.
Well, it takes a lot to form a joint venture with somebody, and I think for the most part, I'm sort of thinking, it's a relatively small number of operating partners where we've only done one transaction with them. For the most part, you go through the process of creating a relationship with another firm, getting to know those individuals, and you make that first investment. We're always thinking about we're not doing this as a one-off. And for those, honestly, I'll tell you, Colby, having done sort of seen it all, and there are those operating partners who are just very transactional. They will have a particular opportunity or a situation or something under contract, and they will go out and solicit capital from a number of different potential providers, partners, and then when the next deal comes along, they do it again, and it's a matter of soliciting term sheets and who's going to give me the best deal, and it's a lot less about having a common vision. Look, we're in this; it's a for-profit business. This is not a camp, but you want to have relationships where you can leverage that initial effort and the relationship you build and continue to grow it. So sometimes it may not go beyond more than 2 or 3 deals for a variety of reasons. Sometimes you do a deal and then you buy another one and then you sell the first one. So you really may only have 1 deal or 2 at a time with somebody, but you've done multiple deals together. Sometimes it's building an organization like New Cold, where we now have, I don't know, I think it's some number like 2,000 or 3,000 employees on, as I said, on 3 continents. We've got our partner in Florida, who I've lost track of the number of deals that we've done with Noah and his team. And I think we're probably on number 20 or 25, somewhere in that kind of range. So, finding good partners that you can rely on, that you have respect for and enjoy working with, is really important. And that's one of the ways, as I said, we force multiply Westport by looking for those relationships.
Well, as we kind of go into the final chapter here, I do want to get back to debt. In 2025, where it's a mixed market. We've seen material costs drop dramatically. Overall construction costs are down 9 to 12%. We're seeing material costs down. Labor's, holding relatively flat. Backlog is shortening for a lot of the contractors, and a lot of the design firms are seeing it. So, it's interesting as I talk to a lot of capital market brokers and such. They're starting to forecast more ground up development in 2025, but somewhat could be self-serving. I'd be.
I hope not. We have plenty of supply to absorb in other places. I'm really counting that. That's how you get. I've given several presentations in the last little while. We actually did a webinar for Westport last week where I gave our outlook. It was a closed event to to our investor base and what have you. And it was me, and it was Rob Rubano from Cushman Wakefield, who heads their debt and equity structured program. But one of the things is that we, as I say, the cure for high prices is high prices, and the cure for oversupply is oversupply, right? So you want that pipeline to get shut down, and we're starting to see that. If you look at the forecasts for deliveries in many markets, there's still stuff being delivered now that was started. It might have been conceived of in early 22 and got funded, and they locked their loan before rates went through the roof, or as they were going through the roof, and now these projects are delivering today. Very few new projects started in 23. Although we did start a build for rent opportunity down in Florida, and it's extremely regional. I was just in Miami. I was in Miami 2 weekends in a row earlier in July, And as they say, the state bird in Miami is the construction crane. And
Yep.
there's cranes everywhere and new office buildings being built. My mind was like boggled, like, oh my God, someone's building office buildings. But there is a lot of, I'm gonna meander a little bit and I'll get back to the debt point, which is that, we did have stupid levels of rent growth, both in the residential and the industrial side, especially in the hotter markets, for too many years in a row, right? Low double digit or mid double digit rental growth compounded for a couple of years, clearly not sustainable. And so we're now at a point where, whether it's household income statements or company income statements, need to kind of catch up. The Fed, it looks like they will have stuck the elusive soft landing. It just, we might get a little softening here, but I'm not worried about things like, with the consumer with credit card debt and some of that. But, I just looked at 10 years below 4% this morning. The 5-year yesterday was close at 391, I think. So that indicates to me a little bit of softening, and now we'll start to see the Fed drop the short end of the curve and kind of normalize rates. But what happened in real estate, as I mentioned, is that the Fed, the market peaked in the fourth quarter, call it December of 2021. Some say January, February of 22, and the round numbers were down 20% from that level. We're down way more in office and we were down way more in retail for other reasons. But the capital markets answer to why values are down, it's just the math of cap rates, right? Cap rates, if a cap rate goes from 4% to 5%, all else being equal, that's a 25% drop in value right there. So you add in a little NOI growth, and maybe cap rates didn't, gap out 100 basis points or on average. So that's your down 20%. And that's the motivation for us when I say buying quality assets from distressed sellers, people are in the choppy waters of loans maturing, interest rates adjusting, equity gaps that have to be solved for, and lenders that are saying, look, either, sell your property and take me out, or rebalance your loan because my 60% LTV loan is now an 80% LTV loan. I'm happy to continue with you because you can cover on a debt service basis, but I need you to rebalance the loan. So that's what's generated. And in our most recent fund, we've made 6 investments so far. We have 2 to 3 teed up, and uniformly, it's a distressed seller of some description. And some of them are even off market, where there wasn't even a brokerage process involved. But what I said 6 months ago, I've said it even earlier than that, was that we'll see the real estate market start to turn when debt comes back to the market. It's not about when equity comes back to the market, because the equity, there is obviously a subsection of the real estate market that invests on an all cash basis or a very low leverage basis. And those are typically your core funds and life insurance companies, what have you. But for the rest of us, everybody relies on debt to make up at least half of your capital structure, if not more. So with the only source of debt a year ago being, for the most part, debt funds that were charging 350 or 400 basis points over the short end of the curve, if you had to pay, what I lovingly refer to as Guido rates, no insult to my Italian friends, you're paying 8 or 9%. And we knew that, when I say debt is the oil in the real estate engine, if you don't have that lubrication, then it's not going to function. So we started to see at the beginning of the year, the CMBS market, bonds, spreads on the bonds started to tighten up, even though the CMBS markets hadn't really opened up yet. The credit spreads in that market. And then what happened was capital was coming in the secondary market, and then it started coming in on the primary market. So that opened the CMBS markets up to real estate lending. And now, the stat that just came out was that for the first half of 2024, CMBS issuance has been 3 times the volume it was in all of 23. So that was a big indicator. And my other anecdotal indicator, and Rob kind of confirmed this, but we've been out looking for debt for 3 or 4 deals that we've priced in the last 8 weeks, either in the process of pricing or have priced, and spreads have come in dramatically. So what was north of 300 basis point margin on top of your whatever your index was, whether it's swaps or treasuries, we're now routinely seeing low 200s, and even now we've dipped down below 200. We've priced 2 deals inside of 200. So I've never made forecasts in my life. I don't think I'm that smart or that prescient, but we are definitely at the trough in real estate values, especially for the assets that are still performing, where the operating fundamentals are still in good shape. And so those are the things that we're looking at. I think if you look at any chart over the history of time, the last 30 or 40 years, real estate values, if you look at a long enough time window, have always exceeded the prior peak. And so I can't forecast when we will do that. I just feel like prices have really firmed. And the only real-time, near-term data point that I can look at is that coming out of the financial crisis, markets basically peaked in the fourth quarter of 2008, even as everything was cratering. And it took 4.5 or 5 years. It took really into 2014, 2013 for prices to reach their prior peak. And that's NCREEF data. The REIT markets on the public side, they recovered much faster. But on the private market side, it took about 4 or 5 years. We are 2.5 years since the peak. So we're already 2.5 years into that recovery cycle. So does it take another 2 years? Will it happen sooner? It doesn't feel like it'll happen sooner. Could it take longer than 2 years for prices to recover? Could do. But that 2 to 2.5 years from now is what we're baking into our thinking, I will say, in terms of when we would see prices sort of reach the prior peak. So it makes us very interested investors today. It's hard. You can only tell the bottom in retrospect. As someone once said, they don't ring a bell at the bottom. But the public markets have already really recovered. I think 2 weeks ago or a week ago, the RMZ, the Morgan Stanley REIT Index, hit a 52-week high. So I think the public markets are telling you. And Lineage did their IPO last week, which is the cold storage. It's a real estate firm. It was a huge success. So that's a niche sector, cold storage, but still equity demand. So that's why I feel very bullish right now in terms of what our long-term prospects are. And now with rates starting to come in, which could be presaging a softening, an economic recession. But I think with debt prices, debt costs coming in, this does set the stage for a nice recovery.
Yeah, it's interesting. If I was to go anecdotally out of history, to me, I won't go back to the 90s with it, but it was reminding me of kind of the second, fourth quarter of 2009 to beginning 2010 is what it gives me a reference, like, as I'm seeing debt come back in. Market, to your point, equity has never gone away. It's been on the sidelines. Redemptions are down, with funds, etc. People are there. It's just, you're starting to see the debt want to open up, swaps be able to come in, where we have some of our clients, starting new multi because it's the entitlement time, because the cities are backlogged, are starting because it's going to take, now we're at a 2027 delivery or 28 delivery in markets where, we're seeing some of our clients, get serious about ground.
And I think you will see some of the data, is showing that deliveries are going to be a lot, are going to be down a lot in 25 and 26. You're still going to have deliveries. So, but there is some, baseline level of absorption. And as I said, that I don't think we have to wait till 28, to sort of hit prior peaks. But I think we're, in that time range, that's sort of 26 to 28 timeframe.
Well, Sean, it's always a pleasure to spend time with you, both personally and professionally. Say hi to Ani for me. And if anybody wants to get hold of him, you can get him through his website or reach out to me directly for either as a great LP partner or, looking for career advice and other. And please tune in again and like and share, and feel free to follow Sean at Westport Capital Partners as well. Sean, thank you for your time today.
Thanks, Colby. It was great chatting with you.
You too.